Hey everyone, today when the Indian stock market is touching new highs and majority of companies are trading at all-time high, over the weekend I did an extensive exercise to identify a few fundamentally strong businesses that have corrected up to 35 to 40% from the peak due to short-term challenges that created negative sentiments for the company. And in my opinion, these stocks are looking attractive to consider investing at current levels for potential gain in the long term. Having said this, nobody can time the exact bottom. So there could be some correction or consolidation here and there. But if you keep patience and courage, these companies should reward investors. Before we begin, I would highly encourage you to do your further research before investing your money. Alright, let's get started. So first stock in my list is from large cap banking sector. It's Kotak Bank. Now Kotak Bank has been one of the biggest wealth creator in Indian stock market history. However, this stock has not generated any return in last 4 to 5 years. So first of all, please understand that Kotak is a very strong banking franchise. Under the leadership of Mr. Uday Kotak, Kotak Bank has become one of the top financial institutes in India. However, there are certain challenges that resulted in negative sentiments for the bank. The biggest challenge for the bank is change in senior leadership. So Mr. Uday Kotak, who founded Kotak Bank, had to resign from the bank due to RBI norms after nearly 4 decades of extraordinary leadership. And then recently its joint MD KVS Manian has also stepped down after nearly 30 years of journey with the bank. Now in banking sector, senior leadership plays a very important role. All sentiments are tied to the leadership. On top of that, recently RBI banned Kotak Bank from onboarding new customers via their mobile and online banking channel, and also directed the bank to stop issuing new credit cards due to compliance issue on their IT side. As a result, some brokerage houses like Nuvama have downgraded Kotak Bank with a target of 1530. As a result, Kotak share price has tanked around 21% from its peak, net trading at 5 years ago price. So folks, I acknowledge that there are challenges, but I also feel that majority of bad news is already priced in. From here, the risk rewards are in favor. Kotak has recently declared its Q4 result and its PAT has grown 17% year on year, which is better than estimates. Company's asset quality, then profitability, everything is on track. In fact, if you look at its top line and bottom line, it has grown every year at a very good rate with more than 20% compounding. But since the share price has not grown, its price to book ratio has fallen from peak of 5.8 in May 19 to now at 2.5. Screener is showing 2.8, but it is actually 2.5. So I believe that market has already discounted the negative news, and from here risk rewards are in favor. Only if you are a long-term investor. By the way, friends, today Kotak has jumped around 5%, but I already tweeted about it on weekend. So if you are looking for almost real-time update on stock market, you can follow me on Twitter as well. Now next two stocks are from mid-cap IT sector. First is KOF Forge. After Q4 result, company share prices tanked 10% on Friday and a total correction of around 35% from its peak. Again, brokerage houses have downgraded the stock with Jefferies target of 4,290, InCred target 4,430, Citi target of 4,550. And now KOF Forge is trading at around 4,500 with a market cap of 27,500 crore with a PE ratio of 35. So again, in my opinion, the worst has been priced in. Now first try to understand the reason for downgrade. So first reason is slowdown in growth. In latest Q4 result, KOF Forge top line has grown by only 9% year on year. On profit, while net profits have jumped 42% year on year, but that because of low base in Q4 of FY23. As compared to Q3 of FY24, net profits have reduced by 5.7%. More importantly, management has not given any guidance for FY25 due to the uncertain macro environment. So weak performance in Q4 and uncertainty in FY25 due to slowdown in US resulted in price downgrade. On top of this, KOF Forge has recently acquired 54% stake in Signity Technology for around $220 million, which is roughly around 1800 crore. While this would help in increasing company's top line, it would impact company's EPS. Overall, I think that this acquisition would be beneficial for KOF Forge in the long term. But due to negative sentiment and price downgrade, KOF Forge share price is corrected. In my opinion, investment made in the company today should reward long-term investor in the next few quarters. Then second IT stock is Persistent System. It is one of my most preferred mid-cap IT stocks. Although now market cap has increased, so it's sort of become a large cap. Now after a brilliant growth in share price, it has corrected 24% from the peak. Again, the reason is relatively slower growth in FY24. While company's revenues have jumped 46% in FY23, its growth for FY24 was 17%. And net profits growth has reduced from 33% in FY23 to 18% in FY24. Persistent commanded a premium with a peak PE of 66 and now PE has fallen to 48 with market cap of around 52,000 crore. Although it is still slightly on the higher side, a PE of 40-42 would be good buying levels. But considering the potential in the company, Persistent has created a good buying opportunity with 24% correction in a systematic manner. Again, further correction will only make it even more attractive. In fact, I believe that after a very long time, IT sector should create good buying opportunity in FY25. That should reward the investor in FY26 and beyond. Maybe I can do a separate video on the IT sector. Now, fourth stock in the list is from hotel sector. It's Samay Hotel. I've recently done a detailed video on why I find it promising. It's a recently listed IPO with a unique business model where it acquires properties, revamp it and rebrand it. For example, it acquired, let's say, a 3-star property, revamp it and make it a 4-star or 5-star and then give it to top brands like Hyatt, Sheraton, Marriott, Holiday Inn. Interestingly, it only caters to the business travel in gateway cities of India like Mumbai, Delhi, Bangalore, and currently company is in loss at net profit level, but management has clearly guided for positive net profit starting Q4 of FY24 or Q1 of FY25, that too on a sustainable manner. Considering the growing business in India, the trend for business travel would only increase over time, and there's a lot of scope for price appreciation in Indian business hotel, which are priced at much lower level as compared to global peers. Samay is well positioned to benefit from this trend. Its share price is down around 18% from the peak, and today it is most attractively priced hotel stock with an EV to EBITDA of 23. I've been quite bullish on company's future prospect. In fact, I've also added it in my portfolio. And I also share my own investment detail in my weekly video series that you can explore on my website or via the join button. Now, fifth stock in the list is from tech domain and travel industry. It's RateGain Technologies. After a very good rally in share price, in the last 3 months, RateGain share price has corrected 28%. RateGain is the largest software as a service provider in the travel and hospitality industry in India and a leading global player. Just to summarize RateGain business in layman language, when you look at hotel and airline prices, RateGain collect the data and share it with hotel and airline companies to optimize their rate as per demand. So sometimes when we are checking the flight rate and it suddenly increases, now you know whom to blame for this. Anyways, that's one of the business vertical. It also have other verticals like distribution and digital marketing. Now let me share some data point with you that would help you understand why I'm bullish on RateGain. So in the last con call post Q3 result, management increased their revenue guidance from 65% to 69% in FY24 and margin guidance at 19.5%. In FY23, company did a revenue of 565 crore and 69% revenue growth implies FY24 estimated revenue at 954 crore. And so far in last 3 quarters, company has done revenue of 701 crore. It means to achieve management guidance of 69% growth in FY24, company would have to clock revenue of 253 crore in Q4 of FY24. And that would be 38.7% growth in Q4 number versus Q4 of FY23. And EBITDA growth should be around 54%. Although in Q4 of FY23, company's tax was negative, that resulted in higher net profit. So in Q4 of FY24, post-taxation, the net profit growth won't look very high, but profit before tax should be more than 50%. Today, RateGain is trading at a PE multiple of 60, which is on the higher side, but considering its SaaS business model with leadership in domain and growing trend for travel and hospitality, it should command a premium. So this 25% correction has created a good investment opportunity to consider accumulating RateGain for long-term wealth creation. Now, sixth stock is one of the top brokerage firm of India. It's AngelOne. If you look at its financials, AngelOne has been growing at an exponential rate across both revenue and profits, and share price has also appreciated significantly. But recently, there is 32% correction in its share price, and today, AngelOne is trading at a PE ratio of 21 with a market cap of around 24,000 crore. Now, considering the cyclical nature of brokerage industry, I understand that AngelOne won't command a very high premium, but currently we are in upcycle. Due to growing trend for stock investment and brokerage firms like AngelOne should benefit from this trend. Hence, I think AngelOne is looking very promising at a P ratio of just 21. Also, please note that company is diversifying into multiple domains like AMC, wealth management, insurance distribution, lending platform. So there's a lot of scope for growth in the company for long term, and hence I think this correction has created a good opportunity. Although Jio Financial has also announced the expansion in sectors like brokerage, wealth management, and that might have created a negative sentiment for the company. which resulted in correction. But I believe that this industry is very large and geo entry should not have a very negative impact on AngelOne. It should continue to grow at fast rate in the near future as well. Hence, worth considering for long term. Seventh stock in the list is TLA Platform. Now, TLA Platform is taking a test of patience of investors for a long time now, and stock is down 32% from its 52-week levels. I've already discussed in the past why I'm bullish on TLA Platform. It is India's largest CPaaS company, that is communication platform as a service provider. One of the simple use cases is the SMS that we receive on phone. TLA provides this SMS solution. So whenever we make a transaction, the OTP is received via TLA Platform. However, today, WhatsApp messaging is also growing big time, and companies are using it for marketing and communication purpose, where again TLA comes into picture. So I am bullish on TLA's platform business that has more than 90% gross margin and growing at 30 to 35% CAGR rate. Moreover, I am closely tracking its Wisely ATP solution to curb phishing attacks. TLA has won only one contract so far with top private Indian bank, and management has mentioned that the deal conversion on Wisely ATP is on slower side. Mainly because bank says that if customer is losing their money by sharing password and OTP, that is customer's liability and not bank's liability. So banks are hesitant in paying for this additional security. So there is a need for more clarity on this in terms of who should take the liability. Still, I think the way we are moving towards digital communication, TLA has strong growth potential, and today it is trading at a P multiple of just 22. Now, 8th stock is AAS Financials. AAS share price is down nearly 50% from its all-time high, and I've already explained the reason in my previous videos. Now that company is back on track with technology upgradation, its disbursement have improved significantly by 39% growth in quarter-on-quarter and 20% growth on year-on-year disbursement. Moreover, due to technology upgradation, company's TAT, that is turnaround time, has now reduced to 8 days in Q4 of FY24. I think these are very positive changes and company is back on track. Even DIs are adding it consistently. Currently it is trading at a P of 25, price to book of 3.3, market cap of around 12,500 crore. So these are the 8 fundamentally strong companies that have corrected between 20 to 40% due to short-term challenges and came into my radar. Apart from this, there are a few more companies that I'm tracking closely like AngelOne, IQ Lighting that have corrected significantly. We'll review them post Q4 result. Now before we close this video, I just want to share my views on 2 more companies, MTAR and Traxon Technology. So MTR has corrected around 36% from the peak, and I've already shared a detailed review on the company post Q3 result. Please watch that video to get a clear understanding. The reason for correction was sharp underperformance as compared to management guidance. It was because one of the top client of MTR is Bloom Energy, and that has struggled in FY24 that impacted MTR performance as well. However, management has given a strong guidance of 45 to 50% growth, and MTR is reducing its dependence on Bloom Energy in FY25. In fact, management has mentioned it multiple times that they are actually very conservative in their growth guidance for FY25. So I am giving a benefit of doubt and keeping my faith in management guidance, and would closely watch the next few quarters of FY25 before I decide what to do with the company. Finally, on Traxon, again, I have clearly mentioned that I am not expecting any action until the interest rate in the US start reducing, because Traxon provides services to PE firm, VC firm, to investment in private equity market. And currently, due to highest interest rate in US, private investment market is at one of the lowest level. However, once interest rate would reduce, money would start flowing into private companies, including India, and that's when Traxon can do very well. Having said this, it will take some time and test the patience for next few quarters. Considering it's a microcap company, it can be very volatile. So it's not for those who can't keep patience. Moreover, Traxon has a brilliant leadership team led by IIT and IIM alumni that themselves have work experience in top VC and private equity firm. So in this video, we discussed fundamentally strong companies that have corrected significantly due to short-term challenges and looking promising to consider for long-term wealth creation. Before I close this video, I would again request you to do your research so that you can invest with conviction. And in case you want to know where I am investing my money, you can join my weekly video series where I share one exclusive video every week along with tracking more than 200 quarterly results. Also, let me know if I have missed any fundamentally strong company that has corrected significantly from its peak. I'll see you next video. Till then, take care.